Hello, ladies and gentlemen. It's a modern investing on Pod TV. My name is Sasha Star, and today we have guests Dr. Milan Somberg. Welcome to the show.
Thank you for inviting me. Delighted to be here.
Great. And we have Pod TV own Mark Lee. Thank you and welcome to the show.
Glad to be here. Glad to learn about investments. As y'all said, a lot of folks don't know enough about investments. As I was thinking to myself, Sasha, I was like, do I have any investments? And then I remembered that the family actually has timber. So we do have some investments because we have property that has timber and that has been passed down from generation to generation, including some houses up in a rural North Carolina. So we have some houses that have been passed on to generation, and there is actually timber there. So some people do not remember that timber can be an investment as well. So I do have some investments because we have some family timber as well as some family properties.
Excellent, Mark. So that makes you a person with stake in the investment. And we are going to discuss the latest development, although we are not so much in timber or real estate for that matter. Or in violence as well, as all of them can be very, very potentially lucrative investments, as we all know. So the market is, as it's not Wednesdays. And last week, if you remember, I recommended last Wednesday stock Palo Alto Network, symbol PAWN. And it did tremendously well and contributed greatly to performance of my fund portfolio of 11% for the past week. And that's, I think, pretty good development. And I think it will continue to go higher because it has earning report later this month. Same as NVIDIA, by the way. NVIDIA is also doing quite well. However, today, I cashed out about 50% of my fund portfolio because normally I'm a little bit leery about Thursdays and Fridays, especially if the economic data will be revealed and so on. So I decided to take it easy and ready to invest again as soon as the right opportunity will come along. And okay, and that Milan. How are you doing during this last week?
Well, I promised the last time that we were together last Wednesday that I would talk about hidden fees. Now, Mark said that he doesn't have a lot invested in the stock market, and you mentioned before we started the program today that many of our viewers don't have much investing experience. And so to those people, I like to say that we need Wall Street to execute our orders, but Wall Street is not our friend. More crime is committed on Wall Street before noon than any other place in a whole year. And much of this crime is legal crime. And when I say legal crime, it is legal, but it's criminal at the same time. So let me give you an example. Suppose that you needed a different power cord for your floor lamp and another power cord for your toaster and another power cord for your desk lamp and another power cord for your fan. That's what you have in the internet world where you have a power cord for your smartphone that's different from the one that you have for your desktop, different from the one that you have for your notebook. There are 12 different kinds of power cords. This is all legal, but morally it's criminal. So you have that. Now, interestingly, about 50 years ago, the top earners in any profession, say medicine and engineering, dentistry, architecture, the top earners in any profession had the same incomes as the top Wall Street bankers. Same incomes about 50 years ago. Today, a top Wall Street banker makes in a week what a member of any other profession makes in 2 years. Hello, what happened? Well, how can they do that when the transaction costs are under $10 per transaction? Whether you are buying or selling $1,000 worth of security or $1 million worth of securities, transaction costs are $10 or less. Many don't charge transaction costs. Where are they making their money from? When you have this great wealth difference between top earning Wall Street bankers and top earning other professionals. Where is it coming from? Well, it's coming from hidden fees. And these fees, you can find them, except they're in small print, and you got to do a lot of digging to find purchase fee, exchange fee, redemption fee, management fees, administrative fees, accounting fees, distribution and service fees, front-end load, back-end load, and more. There are more. All these fees are there, which make it possible for a top Wall Street banker to earn in a week what it takes my colleagues 2 decades to earn.
So, Dr. Milan and Sasha, just really quickly, as you were saying that, I had a quick question, and some of the other listeners may be thinking as well. But, if you follow traditional banking and traditional banking spaces, a lot of people get caught up in those fees. There are those kind of like overdrawn fees and a number of other fees that can be in that banking space. So are there similar types of fees in the investment space that people need to be aware of and cautious of if they are making investments and are first-time investors? Because I do know that in the traditional banking space, a lot of times people will wind up losing their shirts because of overdrawn fees and other hidden fees that exist. So is there something similar in the investment space?
Milan, would you like to address?
Well, there's investment banking, which is different from regular banking. When you go into your bank to deposit money into your account, it's not the same as investment banking. Investment banking is substantially different, and the two are together now under the same banner, whereas they used to be separate. After the crash in 1929, the legislature was introduced to separate investment banking from traditional regular banking, which I think it was either Richard Nixon or a president roughly at that time in history who allowed traditional banks to own investment banks. And so the trading houses were bought up by banks, all of them were. And so that makes it possible for these banks to use other people's money to put it at risk and invest at risk. And they become so big that we got an expression that was formed, I think around 2008, too big to fail. What does too big to fail mean? It means that if the bank fails and it's so big that it would frighten everybody else who would rush to the bank to withdraw their money, and the money wouldn't be there. It wouldn't be enough money there. The reserve requirements, that's what they're called, reserve requirements have to meet the possibility of every investor, every depositor rather coming in there and wanting to take his money out. What that has to be available. It isn't today. So the government has to step in and bail out the banks which are too big to fail.
There is another consideration, is that all these large banks, financial institutions, they have thousands of employees, and
exactly.
All these people have to go on the street, and that's not a very positive development. And to mitigate this problem, at least from my point of view, I don't bother with any loaded investments like mutual funds or ETFs or anything like this. I'm very happy with individual stocks, and my exposure to fees is based only in commissions with let's see, with discount brokers that I have account with. A charge is $3.95 for a transaction which may involve tens of thousands of dollars. and therefore it's negligible. And I don't even worry and don't count on the commissions and as a consideration whether to go into certain purchases or buy or expenditures or buying back or selling short or options or anything like that. It's not even consideration. And besides this $3.95, I don't see any other impediment on my transactions. Milan, is that right?
Yeah.
Yeah, along those same lines, I was just wondering if you watch modern television, you watch definitely some of the commercial things that are out there. There are a lot of people that are not just pushing crypto, which I've heard y'all's conversations about the negative aspects of crypto, but they're also pushing what some people consider to be a simple way to get involved in investments, whether that be Acorn or whether that be Stash or whether that be a number of other internet banking type of programs. So I was just wondering, what is y'all's two individuals' thoughts about those kind of programs? Because I know that you can go on just about any internet and you will find people that are trying to get you to invest in the two that I just mentioned, but there are others that are out there as well as a way to save some of your nest egg and to save it for a later time. And like I said, those are the two that automatically came to my mind, but I know that there are hundreds, if not thousands of other ones that are out there as well.
Well, Sasha, you talk about buying individual stocks, and as the price rises, buying more. And that's called momentum investing. And it works because the trend is your friend until it isn't. It does get to a point where it will reverse itself. Now, a trend is much more likely to continue than it is to reverse itself, but ultimately it will reverse itself. So in order to benefit from momentum investing, you have to stay on top of it constantly. So for example, individual stocks you're talking about, we at the Monday Morning Millionaire, we have about 300 members. We talk against buying individual stocks because you can have an Enron and you can have an Intel, you can have World.com, these kind of securities which fall out of bed and people lose everything. You know, I have a friend who was a close friend to one of the top Toronto Dominion bankers in Canada, and one of the top people at Toronto Dominion, recommended that he buy Nortel when it fell about 50%. They went from about $120 a share to $60 a share. So a top man at TD Bank says now is the time to buy. And as you know, Sasha, Nortel went to below $1, went to close to zero. And the interesting thing about this, to me, is that people at the top of Nortel walked out rich. None of them went to jail. It was different with Enron. With Enron, a lot of people who should have gone to jail did go to jail. But people who worked for Enron and who had their pension fund totally tied up in Enron stock wound up having to be greeters at Walmart at age 70 and older because they had lost all their assets. So the risk of buying individual stocks is significant. Picking the right individual stock, as you have done, takes some know-how, it takes some luck. And so you mentioned a book, Sasha. What was it called? Investing.
One is Market Wizards.
Market Wizards. I downloaded Market Wizards and I took a look at Market Wizards, and it really, the wizards themselves are opposite of everything that conventional
wisdom
investors, conventional economists agree on, such as, for instance, everything that can be known about a stock is constantly available. That information is constantly available to everybody, unless you are using insider information, which is illegal. And so because it's always available to everybody, whether a stock goes up or down is something that everybody will know. Therefore, you can have no advantage from the knowledge that's available to everybody. These market wizards are the exception to this rule, but they're the Mozarts of investing. And for every one of those, there are millions of people like me and everybody else out there. And you might be one of these market wizards, Sasha, but
no, not there, not there, because unfortunately I don't do commodities, futures.
Exactly.
There are few who use the only stocks and options. So that's probably the closest thing to what I'm
Yeah,
doing.
that's right. You
But
know,
of course, I'm doing that on very limited scale because I'm using only fund portfolio for these reasons. However, again, what I'm saying is that it's not a stock market; it's a market of stocks. So um, to me, for example, S&P, it includes some of the stocks that I love and investing in, but it has a lot of very weak stocks,
of
like,
course.
for
Yeah.
example, Walgreen Boots. It's a horrible stock. It's part of Dow Jones, believe it or not. It's part of S&P 500. So I might as well buy the other 499 stocks and just eliminate, for example, Walgreen and Boots. And with Walgreen and Boots, there are a few other stocks that I would eliminate. But I'm going much farther than that. I'm eliminating 495 stocks and concentrating on 5 stocks what are leaders of the market, which contribute, say, 25%, if not more, to S&P 500. And whereas there is a great deal of confidence that to say that, let's say, NVIDIA could be a next Enron or Nortel, it's highly unlikely. Okay, I would put it that way. So if that's the case, um, what is impediment for me to go and concentrate my at least fund portfolio on a few market leaders, very strong, very solid, highly liquid stocks with a great option premiums in it. And by the way, most of my profits are not on stocks themselves, but on options. For example, with Palo Alto Networks, I'm selling cash covered puts.
Yeah.
And that's a great deal of making money because my philosophy is this: is the stock really something that you would like to have in your portfolio? Answer is yes. Now, would you like to have it at reduced price? Answer is yes. So you're selling put and waiting,
Yeah.
hopefully, to be exercised. Now, the movement was so great on Palo Alto Networks that I was closing already several times my positions with profit and selling higher exercise price puts. So I started with 190 puts, cashed out, went to 195 puts, out, profit. 197 and a half puts, out, profit. So now I sold 202 puts. It's already profitable, but I'm holding on to this position because it might expire worthless, hopefully. But if not, I'm ready to be exercised. Premiums are incredible.
I'd like you to comment on what David Svensson said. The late David Svensson headed the Yale Endowment, and of the 2,000 universities or so that exist in North America, the Yale Endowment is the only one that beat the market. And David Svensson, who headed it, did so by investing in unusual investments, say some aspects of real estate and commodities and futures and so on. And so he was able to beat the market, the only one of the 2,000 university endowments. And he said, David Svensson said that your chances of beating the S&P 500 over a sufficiently long time after taxes and other expenses are virtually zero. And so we can teach a high school student in less than 15 minutes how to equal the S&P 500, how to beat the S&P 500 like your stars have done. Is a Mozart-like approach to investing, and there are very few that can do that. So reading about them, while it is interesting, it's very unlikely that people like me or most people could equal their performance. So you're a musician too, Sasha. So as a musician, you understand what Mozart was able to do. Yeah, unbelievable achievement. You know that they said that if somebody like you went to copy out all of Mozart's works, it would take you 72 years. Mozart didn't live to be 72. I think he was 33 when he died. How could he do it so quickly? Because it came from his head, through his hand, through his pen, right onto the paper. He didn't have to turn and look the way you would have to do that. So for every Mozart, there is a huge number of musicians out there who are not Mozart. For every one of your investment stars, there's a huge number of investors out there who are not investment stars. So we have to take that into consideration. And
Hey, Milan and Sasha, just really quickly, I know a lot of times people will think that when they want to invest in stocks, that they want to go for something that is, and it's something that you said before we began the show, Milan, that something that is widespread and common. So, I mean, hopefully we all on a regular basis use soap and use toothpaste. So some people may think that they would want to invest in, say, Colgate, or invest in whatever their brand of soap is, Dove, or I think that's Procter & Gamble that makes that, or whoever the particular manufacturers are, or people may want to be investing in cell phones because cell phones are so prevalent. So should they be investing in prevalent items, or should they be looking at something that is a little less common? Because I know a number of people will be like, hey, I'm going to invest in that because it is something that the entire society uses, to your point about the cell phone, because everybody and their mother, grandmother, and whoever else they've got in their family seems to have a cell phone these days. So it seems to me that a cell phone provider would be a good investment, but I could be totally wrong. So what is y'all's thoughts about that?
Well, we're nervous about buying individual stocks, whether it be Colgate,
quote unquote common.
So we don't buy individual stocks. We don't recommend it, except in a fund portfolio. But many of our members don't even bother with a fund portfolio because most of the time, investors trail the market by 40% by trying to select individual stocks. And Sasha has done better than that. But the average investor today in the United States and Canada trails the S&P 500 by 40%. So doing that in a fund portfolio can be a lot of fun if you can accept the losses. But equaling the S&P 500 is something that a high school student can learn to do in 15 minutes. Picking the right stock by looking at the balance sheets of those stocks is enormously complicated. There isn't a single line on a balance sheet that cannot legally be changed except the top line. Changing the top line is illegal, but every other line can legally be changed to be what they call creative accounting, to make things look much better than they really are. So picking individual stocks, we're against that, regardless of how good they might look.
Even in fund portfolio?
Oh, in a fund portfolio, no, that's right. In the individual stocks, you can pick individual stocks in your fund portfolio. But like I mentioned earlier, people's fund portfolios trail the market by 40%. So
all of them
have a fund portfolio which will allow you to sleep if you lose it entirely. You don't have to.
Tell me, that's worrisome situation. So your 300 members are losing 40% in their fund portfolios. Is that correct?
A lot of them don't have fund portfolios anymore, but yes, those who do are losing their 40% of what's invested in their fund portfolio. But their fund portfolio is of a size, that's what we recommend, that if they lose it all, they'll still be able to sleep and they won't have to eat cat food.
But the reason that they still have fund portfolios while losing 40% of its value, they're not going to be there for long, say a couple of years, maybe maximum. Is that right?
In a fund portfolio?
Yeah. Well, if they lose 40% and another year they will lose 40%, I don't think that they will stay.
What I've seen from the way we talked in the past, Sasha, you and I don't entirely agree about what Warren Buffett is doing. I've had nothing but Berkshire Hathaway for about 15 or 20 years. For the longest time, I recently got out of it because I got into derivatives, and the derivatives on Berkshire are only once a month or something, and I was looking for weekly derivatives. But Warren Buffett's favorite holding period is forever.
But we are talking about fund portfolio, Milan. What Warren Buffett has to do with the fund portfolio?
Oh, well, no, you're right. No, but like I said, many of our members don't have a fund portfolio. because
No, I'm talking about those members who do have fund portfolio, whether it's 40, 50%, whatever. There might be some people, or is there nobody has fund portfolios.
a lot of people don't like to talk about their losses, and I think that we should be listening to the people who are talking about their losses rather than.
I see. I see. Well, anyway, I'm willing to help those people who have fund portfolios and make them profitable.
Many of our members are actively involved in their profession. Many of our
Yes.
members, because I'm a dentist, many of our members are dentists. There are others as well who are involved in their basic profession and that derive their incomes and savings from the earnings in their profession. And so managing core portfolio, which is entirely based on the S&P 500, takes almost no time at all. We did a survey of our members some years ago. They're spending an average of 15 minutes a week. Some people are spending 8 hours a week because they enjoy the process, and that's great. And doing that in a fund portfolio makes a lot of sense. But because many of our members are actively involved in generating income from their profession, they don't have the time for that. So better to spend time earning money as an architect or an engineer or as a dentist or professional than trying to beat the market, which very, very few people can do.
It's a little bit controversial, Milan. What you're saying is that people have fund, some of your people have fund portfolios, losing on average 40% a year.
That's the
They do have a professional income, which they rely upon. So basically, for them, it's probably a type of gambling that they really love. So instead of playing blackjack or some other gambling or making bets on sports, so they're doing their bets on some stock movements, losing most of the times. Doesn't make a lot of sense to me, but listen, if they're happy with that, why not?
The element of gambling in the stock market can be major and very strong. It doesn't have to be that way. You can safely invest in the stock market and derive a decent income. If you're selling covered calls or selling cash secured puts, you can easily make 11, 12% annually, which is a very decent income. At that rate, money doubles itself every 4 or 5 years, and you can live on that very comfortably. That the traditional regulation is that you should withdraw 4% of your portfolio to live on. So if you have $1 million portfolio, you can withdraw $40,000. That's not much of a life, is it? So you can, if you are writing covered calls and cash secured puts, that 4% becomes 11%. You can need a much smaller amount of money to make a decent income if you can generate 11 to 12%, which you can with derivatives used correctly. Now, Warren Buffett called derivatives financial weapons of mass destruction, and more money has been lost than made in derivatives because of what.
That's not true at all, Milan. It's not true at all.
No. If you
only buyers are losing.
There you go. Yeah, exactly. Yeah.
So people who are selling, on the other hand, they're right 89% of the times.
Yeah.
So what Warren Buffett is trying to say?
Well, for every seller, there's got to be a buyer, and it's a zero-sum game in the world of derivatives. So that's right. People are buying them. Why are people buying derivatives? They're buying them because they can control a very large amount of money with a very small contribution of money, but the chances of losing 100% are enormous.
Most of the positions are expiring worthless. So I wish Warren Buffett would be a little bit clearer in what he's saying, because a lot of people are listening to him and taking as the his wisdom or whatever it might be, but it's not true at all. He has to be very clear. In spite of his age, he can afford to rely on some help to be very clear in his messages, because a lot of people are reading his messages.
he is not really a stock picker. What happened, he made most of his money by buying entire companies, many of which are traded on the stock exchanges. So it looks like he's picking stocks, but he's really buying companies, has been buying companies at a bargain rate. Now, what he wants now is exactly what John Bogle started, which is what we are doing for his wife. His wife is going to outlive him. So the money that his wife will inherit will be managed exactly the way we talk about, which is it'll be invested in the S&P 500, and she will derive whatever income that generates through growth and dividends. You know, when you are selling covered calls, you have to own the underlying security. If you own the underlying security at the right time, at the dividend payout time, you will collect dividends on it. Yeah, with cash covered puts, that never happens because you never own the security.
You don't need to. You just get paid. At the moment you sell covered put, you collect money. What else are you worried about?
Oh,
You
that's true.
collect-
Oh, that's true. Yeah, that's true. Yeah.
Sasha and Milan, quick other question I had is there been a notion? I know a lot of people talk about it now, oftentimes hear it. It sounds like a wonderful idea if you can actually get away with it. And a lot of people in urban areas and other areas will talk about, I've even heard Shaquille mention it, playing with what is commonly referred to as OPP, other people's money or other people's finances and everything. So how realistic is that, and how does one go about getting those kind of access points? Because I know a lot of folks are saying, hey, I don't have those resources. I don't have that resources. And there are those that will say, maybe you don't, but some of your friend and family circle may. And I do know that that is a common term that is used. A lot of the rappers have used it, and a lot of other people have used it as well. So how realistic is it to find other people's money that you can invest for them or you can invest with them?
I was never interested to have other people's money. I don't need it. I can operate with my own money and make pretty good returns. But there are some people who are offering services like investment clubs or some other ideas or so on. And I have no problem with that. Let them do whatever they want. I wouldn't do it. Milan, what about you?
Milton Friedman of the Chicago School of Business talked about 4 ways of spending money. Number 1 is the way you spend your money on yourself. Number 2 is the way you spend your money on other people. Say you buy them a birthday gift or a wedding gift. Number 3 is the way you spend other people's money, which is an expense account would be an example of that. A lottery winning would be an example of that. And 4 is how other people spend other people's money, which is what the government does. Now, Thomas Jefferson never heard of Milton Friedman, but he understood the principle of other people spending other people's money. And that's why he wanted to see minimal government. And the idea of minimal government died with Thomas Jefferson because, Mark, what percentage of the population works for the government? Did I ever ask you that before?
I can only guess it is a sizable portion because there are a lot of civil workers out there. I know even here in Durham, there are a number of people that are working in government-related jobs. So I imagine that if I was to guess, I know that Duke is a large employer here in Durham. It is not a government employer, but I imagine that probably somewhere in, if I was to guess, 30 to 40% of the people are probably working in some form of government employment.
Your guess is very good. It's actually 50%. You know, you walk into any community and you drive down, say you go into Collingwood, the first thing you see is the hospital. Mm-hmm. Everybody in that hospital works for the government. And then everybody in the public schools works for the government, and not to mention people who actually work for the town, picking up garbage and maintaining the roads and so on. So 50% of us work for the government. And the idea of minimal government, as I mentioned earlier, died with Thomas Jefferson. And that's not going to change because of the bureaucracy involved. You know, a bureaucrat, there used to be a complimentary term because people used to work in the fields and they got tanned as a result of working in the fields. And then somebody got an office job, and he wasn't tanned anymore. So that was something that you could brag about. Look, I don't have a tan because I work in the office. I work in the bureau. I'm a bureaucrat. Well, that certainly has changed. Bureaucrats now primarily are concerned about making the bureaucracy grow, and whether you make any money or not, well, it's nice if you do, but if you don't, it doesn't matter because they're making money all the time. And so that would be Wall Street. And so you want to have as little government involvement as possible, but that's very unlikely to change. Yeah, I think that might be the case in dictatorships. That is the case in dictatorship. The trouble with a dictator is that the continuation is difficult, So you have a great example of dictatorship would be Singapore, for example. And Singapore has the equivalent of oil, except it's their location. The way that Singapore is located, people have to stop their ships over there for refueling and provisioning and so on. An ideal location for today's shipping systems. And that's the equivalent of oil. They're never going to run out of it. It's not a polluting industry. So Lee Kuan Yew, who headed Singapore, really was what you call a benevolent dictator. When he went to make a decision, it didn't have to go through Congress and get debated and so on. He just made a decision and things happened. The same thing happened in the former Yugoslavia, where Marshal Tito was a dictator. And so he was a benevolent dictator. He held the country together. And when he decided something needed to be done, something got done without having to be debated. But there was nobody to succeed him. So when he died, the country fell apart. They thought there were 5 different states there. It was Serbia and Montenegro and Slovenia and altogether. And the country fell apart. They were going to have somebody from each of those sections governing, ruling, heading the country for a year, and then they'll be replaced. That didn't happen. The country fell apart. That's the trouble with dictatorships. Marshal Tito did leave a legacy in that he started the non-aligned movement. And the non-aligned movement is the biggest movement on the planet today. And part of the reason for that is that India belongs to it. And so all these countries that are neither in the Soviet camp nor in the American camp, non-aligned, were started by Marshal Tito, benevolent dictator. But when he
Actually, I
died,
would like to mention an interesting detail. Maybe you remember that at one time, the president of FIDE, World Chess Federation, was Kirsan Ilyumzhinov for many years.
the president of what?
Of World Chess Federation, FIDE.
Yeah.
Kirsan Ilyumzhinov, he was very close to Putin, and he was at one time, I think he was a member of parliament. At one point, he was elected, so-called elected, as president of Kalmykia, a small republic in Soviet Union. It was late or mid 1990s. Okay, once he became a president of Kalmykia, the first thing what he did, he dissolved a parliament of Kalmykia. What he said is that, first of all, he's no president of Kalmykia, he's a Khan. So he's got the title of Khan instead of president. And then he said, I don't need any parliament. Go and work. That's it. That's the end of story. I'm Khan. I'm going to make all the decisions for you people. Parliament, no parliament, just go out, find yourself jobs, and goodbye.
Yeah.
That's what he did. And Kalmykia actually did quite well compared to others.
He sounds like he did really well. Hey, Sasha Milan, I know Jim's not here because he had that dental appointment. So just out of curiosity, Milan, I'm going to ask you, since you are the dentist on the panel and everything, and since Jim had that dental appointment, do I need to go invest in some dental equipment or braces as a investment? Because it seems to me that there may be a run on dentistry, so maybe we need to have some dental investment. So what dental equipment should we be investing in? Should we want to go into the investment in that space?
Interesting question. Dental equipment is becoming increasingly more expensive, and really what a community, let's say have a small town of 20,000 people, there'd be 5, 6, 8 dentists there. They should all invest in one um, large X-ray unit, and they would send patients there to have their X-ray done, and they get a report instead of each individual office having its own X-ray equipment. Well, guess what? Each individual office does have its own X-ray equipment because people don't want others to know how many people they're sending to X-ray view, and so investing in companies that make manufactured dental equipment, if they're properly run, they would have to be a good investment. They would, they're the right thing. Now, you can have an area that is promising and have a badly run company within it. Right. So you have to check the basic fundamentals of the company before you make that decision. But again, you're talking about picking individual stocks, which is a risky thing to do. Most people don't do well picking individual stocks.
No, that makes a lot of sense, Sasha. I got to teach you as well, since I'm here playing in the role of Jim and all in that space. I know that you're a chess master, but you also enjoy some good spirits in it every once in a while. I do have some friends in that spirit industry. So should I be investing or looking at some spirit industries and maybe a chess set as an investment as well? Well, not just to play the game, because I'm gonna definitely buy me a chess set. I think I had one at one point, and I need to get a new chess set if the old one is gone and all in that space. But should I invest in chess game companies and maybe a couple of spirit companies as well?
Well, if you know some people who are in those areas and they're personal friends and they can provide you with inside information. Inside information is illegal unless you obtain it from friends who tell you that this is what's happening. My wife is buying, I'm telling my kids to buy, I'm telling my mother to buy. And so that would be a legal way of getting insider information, and you might be able to profit and benefit from that. Now, interestingly, did I mention this earlier today? The top guy at TD Bank recommended to a friend of mine that he buy Nortel when it was half of what it was a previous year. It used to sell 120, and when it got to 60, one of the top people at TD Bank said to my friend, now is the time to buy Nortel. And it went down to below $1. So I'm not sure.
The timing is everything. If you were buying Nortel at $60 on its way up to $120,
yeah,
do very well. Now, when you're buying stock on the way down, which I'm talking about almost any problem, don't touch the stocks that are going down. Buy stocks and double your position when stock going up.
Momentum investing, yeah, that's modern investing, right, Sasha? It's a part
It's
of
modern investing. The timing is everything. Okay, it could be the best stock, but you're buying it in the wrong time, you're going to lose money. So my philosophy is this: don't keep your losers. If you are in the red, out. Maximum is 7% when you can afford to lose. But I'm not even waiting for 7%. I'm out. Now, if the stock recovers and going up, I'm buyer. But I'm not going to hold.
The downside of your approach, the momentum investing, is it requires a lot of time. You got to spend time watching it. Whereas, you have this rules-based investing and judgment-based investing. And judgment is wrong much of the time. Rules are always correct. Rules are saved. Without saving, nothing else matters. Number 2 is do it yourself. Number 3 is buy the American economy as a whole, not picking individual stocks. Number 4 is buy and hold, don't trade. And number 5 is only trade to bring back your asset allocation to 50-50 or whatever it is. And number 6 is don't buy anything that you can't explain to a 12-year-old. And
Milan,
yeah.
And with all these rules, you'll be lucky to make 6% a year. Good luck.
Oh, no, 6% a year. Exactly. That's what happens. 6% a year. Now, if the suggestion is that you should live on 4% of your portfolio and you're making 6%, your portfolio is growing, you're going to leave a legacy. And I don't see there's much wrong with earning 6% after tax.
Maybe it's a good strategy. It's a good strategy for younger people, I think. Okay, go ahead, Mark.
But I found something very interesting. I know we get ready to end and everything, but I found something very interesting. We have a program here on Pod TV that is dealing with the cruise and travel industry. industry. And actually, the young lady that was doing the show yesterday last week put up some information that surprisingly that industry is doing well in the stock market and everything, because I think Carnival and a number of the other ones were actually doing tremendously well and are forecasted to be doing well over the next several years because of the way that they suffered heavily during the pandemic. But apparently now people are getting back on those boats and are traveling at a regular rate. So I'll definitely be interested to see y'all's thoughts about that, because I was pleasantly surprised when I heard the video from the Carnival guy and some of the other people that are finding that to be a profitable stock at this particular time.
I wouldn't touch Carnival stock, period. Would never touch it because they have exposure to tremendous fixed expenses. And whether they will have bigger cash flow and profits. Actually, there are no profits now for several years. So maybe in 2 years' time, they will generate some profit if they're lucky. They don't pay dividends. I wouldn't touch it. I would run away from Carnival or any other cruise stocks. Even airline stocks probably are better investments, or airplane makers like Boeing probably could be a better investment, but no, not cruise lines.
If you owned every airline that ever was since the Wright brothers first flew in 1903, and you own every airline that ever was, you'd be losing money today. Yeah. And within that group, a few did make money, but you'd be losing money on airlines for sure. And so operations that have large fixed investments, recurring stock expenses rather, Sasha, like cruise lines do, yeah, you're asking for trouble.
I would make exception in airline stocks only for one. It's Air Canada, because it's a monopoly. It controls Canadian market, and as more people will start to travel, maybe that's what I would probably consider, but I wouldn't touch them anyway. But some people may elect it. Well, with that, I would like to thank you very, very much for today's program, and it's a Modern Investing, and we'll see you next week. And have a great week.
Thank you for inviting me.
Thank you. You're welcome. Thank you, Mark. Bye-bye.
Bye-bye.